Saving your first few $1,000s is exhausting. You cut back, you scrape by, and your account balance barely looks any different. This is the phase of extreme discipline, mapping out every expense, saying no to dinners out, picking up side hustles, just to generate a tiny bit of upward momentum. The core vulnerability at this stage is that your progress relies entirely on your own physical output. If you stop working overtime or stop aggressively clipping coupons, your wealth building stops completely. Relying exclusively on manual willpower is draining. When you feel like you are putting in maximum effort for minimum financial reward, the temptation to give up and revert to old spending habits is incredibly high. Early-stage wealth building functions as a test of physical endurance. You are essentially outrunning the clock before psychological burnout sets in. But if you can push through that initial friction, you eventually hit a moment where the mechanical rules of saving change to your advantage. That transition happens precisely when your invested savings cross the $50,000 mark. This chart compares manual saving to compound growth. Early on, the trajectory is flat and linear, but right here at the $50,000 threshold, the trajectory breaks away from that linear path and sharply curves upward. Passing this specific number shifts the burden of wealth creation. You are no longer the only one sweating to grow your accounts. The heavy lifting transfers directly onto the money itself. To see exactly why the math accelerates, we look at the historical performance of the broad stock market, which reliably returns an average of 8 to 10% a year over the long term. When we take a $50,000 base and multiply it by an 8 to 10% return, it outputs $4,000 to $5,000 of fresh capital. That yield provides enough to pay for months of groceries or a quarter of annual housing costs. These thousands of dollars are generated in the background, requiring zero human labor or hours worked on your end. Your portfolio is now large enough to act as an invisible second salary, paying for significant living expenses without your intervention. When your net worth is low, you operate in a state of scarcity. Every financial decision carries an underlying fear of sudden ruin. If you only have a few $100s saved, a routine inconvenience like a faulty car alternator or an unexpected medical bill can wipe out months of progress. With a $50,000 engine running in the background, these shocks lose their bite. The passive income your portfolio generates absorbs random $500 life events before they ever reach your primary checking account. Once you realize a flat tire won't bankrupt you, your daily survival anxiety evaporates. You stop obsessing over making it to the next payday and free up mental bandwidth to focus on long-term strategy. Reaching this milestone moves your focus from daily survival to long-term empire building. Your brain finally has the financial security required to stop reacting to emergencies and start planning for decades. This timeline visualizes the payoff for early endurance. The long stretch represents saving your first $50,000. But the jump to $100,000 is radically compressed. Your second salary dumps returns directly into the principal, piling on top. Compound interest is finally acting as a powerful co-pilot, sharing the heavy lifting required to reach that six-figure milestone. The reward for surviving the early slog is a permanently accelerated timeline toward absolute financial freedom. Knowing this math, your priority is condensing the timeline to reach that first $50,000 milestone as fast as possible. The first lever to achieve this velocity is a focus on income growth, negotiating a raise, switching companies, or acquiring high-value skills. The second lever is keeping lifestyle inflation in check. As your income grows, you must resist the urge to upgrade your car or move into a more expensive apartment. Every extra dollar generated by the gap between your higher income and your flat expenses must be funneled directly into your investment accounts. Stick to the brute force phase with consistency. Keep pushing the boulder, because once you cross the $50,000 tipping point, the math